other organization went off and came back later. When it came back, the recording stopped. So it only recorded up to the end of the breakaway session, and then it stopped, and then I lost the whole of the second session. So you got to be very careful of those kind of things with the Zoom. I didn't realize that.
The breakaway sessions is a problem. Yeah, it does stop when you do breakaway. And then you need to when they come back, you need to re-record again.
Yeah. I had that once with a Jackie seminar. I nearly lost it and had to get it back in when I noticed like a few seconds it was missing. I was like, what's going on?
Yeah.
It was like 140 people who are going to get angry with me.
No, but what happened with this is that when we came back from the session, we had to give a report and decide what our decision, tell them what our decision was, and that part wasn't recorded. So now there's still a dispute. They think that I dropped it because our decision was not in their favor. So I got to be so careful.
Yeah, that's quite inconvenient.
You besides looking stupid, they think that you're trying to finagle the system.
Yeah, these days, sure, no. Anything can happen.
For sure.
Right. Hi and welcome everyone. I'm going to start. I think we can just start early today and just try to get in before the load shedding gets too bad. So I'm going to hand over to Stan to do the introductions.
Okay, so welcome everybody. Those that are joining, we will be starting in a minute or so, just to give everybody a chance to come in. There is load shedding in certain areas, which have come on at 2 o'clock. So I was at a lecture the other day, and the lecturer said, so you must hurry, you must listen in a hurry. Not the speaker must go in a hurry, the listeners must be in a hurry. So that's the advice I'm giving everyone. Listen in a hurry, but we will be, I'm sure that most of you have got some sort of system to maintain your batteries and to run it. Now would be a good chance to nip out and grab a coffee, but we will be starting in a minute or so. So I'll then reintroduce Milan, and Milan will be talking about, as you know, sustainability standards of the IFRS standards, and we will proceed. Just give us a minute or so. Just checking how many people are coming in now.
If anything does happen and you do get logged out due to load shedding, there is a simulcast on YouTube, and that becomes in the recording, which you can catch up later.
Right. Just while we're here, if anybody needs certificates they've missed in any form or along the way, please let me know. I'll send them to you with pleasure. If you do want to catch up on any seminars that you missed, then let me know as well. We'll send you the recording, and then you can listen, and we're happy to send you a certificate. I can go back quite a number of years. In fact, this morning I had a query going back 2 years, so I can always help. We'll just give it another minute. Start at 13:04. Okay, welcome everyone. I'm sure that most of you have now joined. If anybody joins later, we'll be able to listen to the recording at some point. And if you do miss out or anything goes wrong, we will have a recording available. So we are pleased to have Milan van Wyk, Senior Lecturer in Accounting at the University of Johannesburg, talk about his favorite topic, IFRS, and sustainability standards. And so I don't think there's much more that one can say, but Milan, the floor is yours.
Thank you, Stan. Thank you so much for the introduction. Today we're going to talk a little bit about IFRS, but in a different context. So I'm going to take you guys through the journey today. A lot of stuff happening in the sustainability or ESG space, but I'll give you guys the context as we go along. All right. So, and again, if you have any questions, please pop it through to the Q&A, and then we can address it as we go along. So just a quick one in terms of, disclaimers and my professional opinion. So this is quite a new topic. Well, that's why we have the CPDs and everything. So everybody's still learning this topic and getting to grips with all the new disclosures and the requirements and what you need to do. So I'm also new to this. I've got some experience, but also learning as you're going. So just want to let you know about that. But again, I also learn from you and your experiences and your viewpoints on certain matters. So again, if you have any questions, any comments that you want to make, please put it into the Q&A. Right. So for the agenda for today, so I'm just going to quickly just give a background to ESG, what ESG is. And then I'm going to give a little bit of an overview from that in perspective of South Africa. And then I'm going to talk a little bit about climate change and the impact that it actually has on financial statements in terms of IFRS. And then the real deal, the big thing that we're going to talk about today is the new ISSB standards that the IFRS Foundation has issued. Right. At this stage, just the exposure drafts, but we expect the issued standards to come out by June, July this year, if everything goes according to plan. Right, and within those two standards, we're going to talk about the first standard, which is a general sustainability standard. And then secondly, we're going to talk about the climate change standard. Right, good. So let's talk about sustainability and the background to ESG. So I'm going to start off with a poll. Danny, if you guys can just put up that poll or run the poll for me. So I've got a question for everybody here, just to get the sense of the room. So I want to ask, what is your experience in terms of ESG? Are you very new to this? Are you a beginner, intermediate, or do you think you're an expert on the topic of ESG? So please, answer once the poll is launched.
Polls up. There's just one or two people left to answer.
Okay, wonderful. Thanks, Danny.
Good.
It's actually the first time that I'm not the host, so I can't see what's happening. So I'm so used to being the host myself. So
yeah, that's pretty much. I think everyone's who's going to answer is answered. I'm going to end the poll now for
perfect.
Last few seconds for anyone who still wants to answer. Okay, entering it and sharing you the results.
All right, great. So it's in line with my expectations. So, okay, wonderful. So I'm glad there are no experts here because nobody's an expert at this stage. Maybe only the people at the ISSB now. But so great. Thank you for the context, everybody. I've got a second question also, Danny. So I want to ask everybody, have you thought about ESG and ESG-related risks and opportunities in your business? So it can be whether or not you're a listed company or PTY. Just want to get a sense of, do you have you thought about it, or is it something that you have considered in the last couple of years?
Okay. All right, we had a good response already, I think. Yeah, it's pretty much everyone answering now.
That's
That and share.
wonderful. Okay, so there are a couple of people, 22% saying yes, and most people say they haven't thought about it. Okay, and I think that's again, in line with my expectation. I think most people focusing currently on the financial stuff, which is important, obviously. And if you think about the South African context, I think we are quite behind in terms of ESG reporting, especially from a regulation point of view in South Africa. If you're not on the JSE, there's not a lot of regulation really pushing you to think about these things. Well, that's my personal view. If you compare us now to the UK and in Europe and the US, where we are in terms of that. All right. So let's just talk about ESG. So what is ESG? So ESG is about, making a difference for the business and the world, okay, from an environmental and social point of view, and creating sustained outcomes that drive value and growth, and also while strengthening the environment and societies. And also, by doing that, also through proper management and governing of the business in an ethical way. Okay, so it's all about being sustainable and a sustainable business, and focusing basically on how you impact on the environment and how you relate from a social point of view, and are you governing your company in an ethical manner. Then what is interesting about ESG is, you don't think in silos. You're not only the accountant doing the accounting work. It actually implicates various resources and areas of a business and disciplines. And again, now suddenly you are working together with environmentalists, environmental managers, engineers, people that sometimes you wouldn't have worked together with, just to get understanding of what needs to happen in terms of an ESG perspective. All right. And so also in terms of ESG, what is it all about? It's for organizations' ability to remain sustainable, like I mentioned earlier. And it depends on a wide range of resources and relationships. Okay, so again, if you look at the term ESG, it focuses on the environment, the social, and the governance aspects of the organization. And it is a slogan that has caught up, or caught fire in the last couple of years. But it's actually, sustainability probably more of a purist view of what it is. But ESG has been like the reporting slogan that originated there from the United States. But anyway, so if you look at the environment and how to combat climate change that's a very important aspect of ESG. Then also looking at the involvement in social challenges and how they build and improve societies and how they respond to the needs of the stakeholders. And at the end of the day, to create sustained value creation, not only for the entity, but also for the stakeholders. And then lastly, also organizations to be sustainable need to basically be governed in a way that is ethical and effective at the end of the day. Right. So why is ESG information important? Okay. So in that graph that I've just showed you there on the screen, you can basically see how much ESG investments, just green investments and instruments that people are issuing, how that has multiplied, exponentially over the last decade. All right, and it's only 2021 stats. There might be 2022 stats available, but I assume it's also going to be quite high. So it really kicked off, in the last 3 years, and I think COVID also had a massive role to play in that. But you can see massive investment into green instruments, and that's just the instruments. And now also what is happening is that with stakeholder activism also, getting more prominence, a lot of investors look at ESG to invest greener, investing in companies that, you can relate to. And again, it's in most cases, it's more the younger population that focuses more on these ESG issues and want to invest into these type of entities. And, a lot more of ESG investments have been happening in the last couple of years as well. A lot of stock exchanges having specific indices for ESG related or green companies, and then you can buy ETFs or a unit trust in that. So there's a lot of focus on that currently from an investment point of view as well. So basically what happens then is that ESG investors also then puts pressure on firms to improve their ESG performance. Okay, so it can basically be a situation of, the large fund managers actually might be in a situation where they sometimes can divest out of the company if they see that, this is not sustainable in the long term. So very important that, that one understands the importance of ESG reporting and information in the in corporate reporting. Then if we unpack ESG quickly, so by now you should understand that ESG is all about environmental aspects, social aspects, and then the governance aspects of a particular entity. And let's just have a look at environmental. So what is it all about? And the thing that most people, if you read the news and you hear the noise from Europe, a lot of people talking about climate change. It has been around a couple of years already, but again, the conversation is getting a lot more rigorous. The UN driving that as well. So climate change, a big thing. So, talking about greenhouse gases, black carbon, the impact that has on the rising temperatures, then ocean temperatures rising, the pollution of the ocean, and again, how important it is for organizations and then to take up ownership and work together to meet those UN SDGs, which I'll also speak a bit later about, the Sustainable Development Goals instituted by the United Nations. And again, if you just look at the graph there, and again, I'm not driving propaganda here or anything like that. I'm just using stats that, that I've got. So NASA also published some information about climate change and the rising temperatures. So there's just a graph just to show how significantly it has moved in the last 50 years, let's say. And I think if you look at that graph, the moment we start industrializing, you can see that impact has had a massive, that movement had a massive impact on the rising temperatures that we are experiencing. Okay, so again, and how do we change it? How do we mitigate it? And that's why we're talking about ESG. We're talking about climate change management, GHGs, United Nations SDGs. So there's so many things that is so important on environment. And I think that's probably the hardest topic on sustainability right now. Then if you look at social, so the social part of it's basically the value that you create for society. So human resources within your entity. You can't grow as a business necessarily if you don't invest in your human resource. Make sure they're happy, that they are stimulated to perform better, to be innovative, to improve. You need to keep your employees happy for that. So good HR practices, how you deal with communities, how do you ensure that the community also thrives within the companies, how the company plays a part in that community's, relationships and how they interact with the company, etc. And then basically, just taking a stakeholder inclusive approach on the social aspect, to make sure that, when you make a decision that you're not only looking at the profit side of things and the cash that's coming in, but also think about what the impact is wider than the entity itself. And therefore, looking at value, not only to you as an entity, but also to society. Then ethics, governance. So governance, all about, the ethics behind being accountable, clear, transparent, objective, all of those nice words that you would find in the King 4 Code of Conduct, or the King 4 Code, sorry. And again, making sure that you're compliant with laws and regulations, that you're just a good corporate citizen at the end of the day. So, that's just a general view of it. But if you look at a mining company perspective, and I've used Implats for this example, so Impala Platinum. So here you can also see how they look at it, how they view it. So environment, obviously climate change, number one, right on top there, how they consume and use water, energy, air quality, how they, look at waste management, how they impact the biodiversity, and also looking at rehabilitation and closure. And then from a social point of view, health and safety, stakeholder participation and involvement. So again, just relationships with the variety of stakeholders that you might have, employees, and then also the mining community around the mine, obviously. And again, for mining companies, there's a great trade-off between, environment and social, that they need to balance out to ensure that they create value. And then from a governance point of view, corporate governance, code of conduct, all of those nice things that one should know about. Okay, so that's Implats. So just let's have a look at sustainability as a whole. So just going to give a quick overview of where things are going with sustainability. So the first thing I want to talk about is the global goals and principles, and that's where you would see the UN Sustainable Development Goals popping up, the greenhouse gas protocols that is used to measure greenhouse gas emissions, and it's also then the Global Compact of the United Nations that you also could consider as part of sustainability and ensuring that you create sustainable businesses for the future. And this is basically where you want to end up. This is a goal or a principle that you want to live up to. All right, and there's other things also that plays a part in this now. The first thing I want to talk about then is, the ESG indices and the roles they play in meeting that. So obviously, you've got investors that want to invest in companies, and they want to invest in the best or the greenest and the most responsible company. And they would obviously go then to, ratings agencies, indices, and see, which companies are there and why I want to invest in those companies. So that basically would, I won't say force someone, but would influence companies to basically be more greener, be more invested into ESG compared to, doing the traditional approach. All right. But obviously, there are views that, say like ESG is just a thing, but the focus should still be on financials. And I think it's true, but you also need to strike a balance between financial and ESG. Then if you look at the South African regulation, so the South African regulation, for instance, if you just look at sustainability, the Constitution of South Africa actually talks about in Section 24 that everyone has a right to an environment that is not harmful to the health or the well-being. And that's a constitutional right that we have, actually. And then obviously there are other acts that also supported by this. But, and again, in terms of, bringing it all together in terms of accountability, some strings need to be, loose strings need to be tied in order to have a good understanding from a corporate point of view as well. Because I think most of the times it's a bit disjointed, and you almost need someone to pull it all together for you. And then the last one, and this is the one what we're going to focus on today, is reporting frameworks. So what you can see there are a variety, a big variety of different reporting frameworks that you can use for sustainability disclosures. You've got the GRI, which is the most prominent, most likely. You've got integrated reporting now as part of the Value Reporting Foundation. You've got the Climate Disclosure Standards Board, EcoVadis, TCFD. There's so many. The CDP, I don't even have that up there. So there's so many. And I think what the problem is with sustainability disclosures is that there's so many frameworks that you can use, and there's not a lot of consistency necessarily. And that's where the ISB has come in terms of, where they want to go. They want to create a global baseline. That's why they develop these new standards. All right. I see that there is a question there. So, hi everyone, is the slides available? And the answer should be yes, Danny. Ne? I just want to make sure.
Yeah, I did send it out. I can post it in the group. I'll post a copy, link to it again.
Cool. All right, and then if you look at ESG, how does ESG link with sustainability? And that's where the, again, where the goals in, where you want to be in by the 2030, basically. So, so the UN has established these goals in 2015 and working towards these 17 goals to transform the world by 2030. All right, and then every country in the UN has signed this development deal or contract or social contract, if you want to call it that. And each country has basically some form of responsibility to work towards these goals. And if you look at South Africa, unfortunately, I don't think we are faring quite well. But there's still time. There's still time, and we hopefully, we as citizens can make a difference in reaching these goals. And I think that's also where corporates can play a massive part in this. Right, and we've got the 17 goals there. I'm not gonna. Well, I can quickly just go through them. So the first one is no poverty. The second one, no hunger. Third one, good health and well-being, quality education, gender equality, clean water and sanitation, affordable and clean energy, decent work and economic growth, industry innovation and infrastructure, reduce inequalities, sustainable cities and communities, responsible consumption and production, climate action, life below water, which is the oceans, life on land, so any other forms of biodiversity, peace, justice, and strong institutions, and lastly, partnerships for the goals. All right. And basically now, how does this link with sustainable ESG now? So if you look from an environmental point of view, and you break down these 17 goals, the climate action, life on land, life below water, good health, zero hunger, clean water and sanitation, affordable and clean energy can form part of environmental aspects. Then from social point of view, again, looking at no poverty, quality education, gender equality, reduce inequalities, decent work and economic growth, sustainable cities and communities. Okay. And then lastly, governance. So again, that's where the industry innovation infrastructure comes in, responsible consumption, production, strong institutions and partnerships for the goals. All right. So that's just to link, those SDGs with, the ESG slogans used. All right. But then again, ESG, there are also different interpretations of, what is ESG. And, in South Africa, we are quite renowned for the integrated reporting movement, and there basically, it builds into the King 4 code as well, and Professor Mervyn King has been the chairman of the Integrated Reporting Council for a couple of years. He's now retired, but again, have a lot of influence on this. And again, it's all about stakeholder activism and corporate ethics, being a good corporate citizen and taking a stakeholder inclusive approach in terms of King 4. And there they actually break down the ESG into 6 capitals. So you look at your financial and your manufactured, and then looking then at the human capital point of view, intellectual capital that links with human capital, and then also social relationship, which is then those 3 basically being the S, and the natural capital being your E. So the governance is actually part of the value creation process. But, my opinion is that this is a more of a balanced view of sustainability, and not only looking at the external stuff, but also looking at, you need to be sustainable as a business as well. Not only look at, the societal stuff. You can't only focus on society and then not make money and can't employ people, can't pay salaries, etc. Okay. And a very important concept here is the concept of integrated thinking. How do you actually think about the process of tying up all these capitals, what creates value, what trade-offs that you need to make in order to create value, not only for the entity, but also for your stakeholders. Right, I see there's another question there. Okay, see the notes. Okay, great. No worries. Right, and I mentioned about governance. So the governance actually is part of the process of value creation. Okay, so if you look at the left-hand side, you've got your inputs into the process, which is your capitals. And then in that white block there's a circle, which is the governance. And the governance basically ties up then how you're governing these capitals in order to create value, or positive, or, positive outcomes, neutral outcomes, or eroded outcomes on these capitals. All right. And again, it's over time, or the short, medium, and long term. That's also a cycle that needs to happen frequently. Okay, because some of the capitals you use, you will go and plant back into your business, and then the value creation process starts again. All right. And this is for me almost what encapsulates the integrated reporting. It's the looking at all the capitals, think about how they actually fit into your business model. How do you monitor risks? How do you strategize? What is your outlook? How do you monitor progress towards certain KPIs that you have in the business? And then basically getting outcomes on these capitals. All right. Good. So moving on. So I just gave you a little picture of what is happening in the current context in South Africa. So in South Africa, obviously, we're still very strong on integrated reporting. However, other frameworks also quite frequently seen on the JSE, for instance. The JSE, for instance, took the TCFD approach on climate change, making sure that the disclosures are aligned on the JSE, and companies start adopting that approach since, well, hopefully since 2021, because that's when the JSE issued that guidance. But anyway, so let's have a look at the impact of climate change on IFRS. Okay, so basically, climate change, you'll, like I said at the start, you'll see it in the news, you'd see it on, social media, people talking about it, people having opinions, there are conspiracy theorists, there are, many views and differing views on this. So basically, climate change, globally, it is a thing. It is something that's considered. And if you look at what's happening in the US, a lot of climate-related disasters happening there. In South Africa, not that evident, maybe not that clear, but people talking about, that those floods in KwaZulu-Natal last year, is that climate-related? Why is it raining that much? The droughts that we had, the cyclones coming through more frequently now, so there's a lot of talk about it. But anyway, not here to talk about that. But the question is, does that actually impact your business model, and does it have a financial impact? Okay, so it actually does have an impact on businesses. Sometimes, if you look at it and you reflect, it's not immediate. But if you go along, then you'd actually see, shoot, it's actually something that can impact me, if I think clearly about it, and I think about the whole supply chain, well, not the supply chain, the value chain of your company, where can climate change actually have an impact? And we'll talk about that a bit later. All right. So, like I said, it's a massive focus point globally, and there's nothing currently in the standards that links with climate change. But if something is material, you need to consider the impact of climate change on your financial statements. So a question that I want to ask, and Danny, I hope you are ready for another poll here. So do you think climate change impacts your financial statements currently? And you can be blunt and honest here. I think what would happen most likely is that you would say that it does not. But hopefully by the end of today, you might think a bit differently about it. But yeah, let's see what the poll says, and when the results comes through.
I see a few people have answered so far. There's a few more still outstanding. I think I'll give a few seconds for people to think about it.
Cool.
And
It
then
is a
I'll
thinker.
All right, I want to close it off. So don't see anyone else being brave enough to answer yet. So I'm going to close it off.
Cool. Okay. All right. So yeah, many of you saying, you haven't thought about it yet. Good. Some people say it's not material. So for some companies, it might not be material, as material as others. And then a couple of people saying, it impacts your risk management of the company. If you look at a lot of listed companies, climate change in recent years has jumped up into the top 10 risks of many companies, not only mining companies, but, if you look at Clicks, it's also there. If you think about Clicks, they're selling, beauty products and supplements and, basically a retail company. So, and they also, deem climate change as a massive risk. So, impairment of assets, I see that coming through, recognition of new liabilities most likely, and then also revenue recognition could also change. All right, so thank you everybody. Appreciate the interaction. So I'm going to quickly just take you through some implications. So if you look at the current IFRS standards and IS1, so it basically has overarching implications, and most likely if you look at judgments and think about if you look at information also in your financial statements, have you omitted material information that could influence the users? So what basically it comes down to is that, in IS1, it also talks about that additional disclosure may be needed to provide useful information that is relevant and faithfully represented in the financial statement. So IS1 does talk about it. It doesn't really talk directly to climate change, but it's say, if you have something in your business that can impact your financial statements, you need to disclose information that could be useful. All right. And again, it all depends on materiality. Okay. And that's why some people said, it's not material. So it could be a situation where, you have done that assessment and you realize it's not that material. So IS1, what can happen? You can have some estimations for uncertainty. So maybe, you've got certain, obligations and, depending on, the climate change impact on that, it could change how you would look at those judgments and estimates in the future. Think about credit risk, for instance. If you think about the KwaZulu-Natal floods of last year, many companies, didn't actually operate. If you think about Toyota, I think they're so far behind orders and shipments because they couldn't operate for a couple of months, and it could actually, impacts their business. So it can impact then your business in terms of you doing business with them, they're a customer of yours, that the credit risk could be changing. There could be a higher credit risk because of, them having some financial difficulties. So it does have a overarching influence over your estimates in the future. Then going concern also, and it's a bit of a wider discussion, but if you've got a business model that's quite CO2 heavy, and there's a strong move towards greener supply chain, etc., and you just continue that, you could actually price yourself or work yourself out of the market depending on how the market reacts. So there are certain considerations for that. IS2, obsolescence of inventory, increase of cost to that more than selling price. So maybe, with climate change, you move towards greener suppliers, and then your cost might be higher, and that actually has an impact on your selling price or your NRV at the end of the day. And there might be some costs that you need to, or adjustments that you need to make on your cost valuation. Some deferred tax implication there could be, Then IAS 38, IAS 16, so maybe new research that's been done, new technologies, can you capitalize these costs? How do you measure your CO2 or green or carbon certificates? Can you recognize it as part of your financial statements? Impairment of assets, that speaks for itself. So if there are certain weather disasters that damages your PPE items. IAS 37, maybe new revisions that one needs to make. Maybe onerous contracts that popped up. Maybe the regulation changes in terms of how many CO2 how much CO2 you can emit, and then you need to pay penalties, or there might be some transitional risks with that regard. IFRS 7, the credit risk, I mentioned that earlier. Your risk management disclosures could change. IFRS 9, you can actually change, if you look at the type of financial instruments that's coming out now with green features, ESG features, you can actually change how you measure your financial liabilities or financial assets, based on the new features of ESG and climate. Then it can also be changed in expected credit losses. And then lastly, or the last two, IFRS 13, there could be some fair value implications also, in terms of the inputs that you're using. If climate change impacts your business and, making it less profitable or less cash flows coming in, it could actually change the fair value measurement of certain investments in your company, for instance. So definitely an impact there. And then IFRS 15, there could be some modifications in your contracts, maybe forms of variable consideration, green or ESG features that you bring into your contract. It could be a change in the target or non-performance penalties that come in based on the amount of CO2 you're emitting. And again, I'm talking very hypothetically now. I'm not sure if South Africa has evolved up until to this point, but it's something to consider for the near future. I think it will move into this direction going forward. Right. So that's just the impact of climate change on financial statements. But now I want to quickly just talk about the new sustainability standards. I think this is what we're going to spend most of our time now. So, we spent 40 minutes just with the introduction. So, and I hope I can finish everything in the 3 hours. I'm going to try and be as effective as possible. But yeah, so we're going to talk about the new ISSB sustainability standards. So what the ISB, or not the ISB, the IFRS Foundation has done, they've established the ISSB, or the International Sustainability Standards Board, which who issued the exposure drafts on sustainability standards last year, but we'll talk about it just now. And it has gone through a commentary or a feedback process, and all the comments has been received, and they're basically in the position now where they are working towards finalizing the two standards, and that they most likely will issue it this year. They're saying, June, July. It could be a bit later, but will definitely be here, and it will most likely be effective quite soon as well, because of the urgency of climate change, for instance. So to get people and companies to report on these sustainability standards. Right. Good. So let's talk about sustainability again. Just going to go through it again. So the big issue that I've showed you earlier is the fact that, we had all these different reporting frameworks. And there's a call from investors, in capital markets to say, like, listen, we've got all these different frameworks. We need something, that creates a baseline or some form of consistency that people can use in order to report on their sustainability issues. And that's where the IFRS Foundation came in at the end of the day. They took on this project in order to create a global baseline. All right, so just quickly on the IFRS Foundation role. So originally, the IFRS Foundation pretty much IFRS focused, dealing with the IFRS standards, IFRS for SMEs, also, facilitating interpretation committees, all of that. But, like I said, capital markets requested for a global baseline for sustainability disclosures, and that's the project that they took on. Okay. So basically what happened then, if you look at the diagram there, so they've created the ISSB, the International Sustainability Standards Board, that will drive the sustainability standards and the issuance and the development of those standards. All right. So it's basically the sustainability side of the ISB. Okay. So the ISB, works with the IFRS accounting standards, the development, post-implementation reviews, all of that. And the ISSB focuses on sustainability. So what happened with this also is once that was formed, they actually consolidated the Value Reporting Foundation, which hosts the integrated reporting framework, as well as integrated thinking, as well as the SASB standards. All right, so it's actually a big organization that has been consolidated into the IFRS Foundation. Okay. They also took on or consolidated the Climate Disclosure Standards Board, because they also have quite good or very good disclosure standards on particular industries, particular focuses, and that they can use part of their standard setting procedures. So they've consolidated the CDSB as well as part of the IFRS Foundation. Okay. Then if you look at the disclosures, so the disclosures the exposure draft that we will look at now is pretty much focused on the TCFD recommendations. So there's a task force for climate related financial disclosures. So they actually also start operating in 2015, and they actually got a lot of traction, especially from the US markets in terms of climate change. And, in South Africa, a lot of mining companies are using that already. And the IFRS Foundation said, okay, we can use this as a basis, and then we obviously bring in all the different components also from integrated reporting framework, the SASB standards, etc. Okay. So how was the ISSB formed? So, it all started actually at COP26 in November 2021, where it was formed. But there was a bit of a lead up towards that, so like I said earlier, in 2020, they already started talking with capital markets leaders, saying that, there is a need for global baseline for sustainability standards, and it moved over. And in 2021, they created the ISSB at COP26, and they basically published the exposure draft for the two standards last year, March. And then there was a consultation process for comment letters, which closed last year in July. And we're basically at the stage now where, they might issue it in June, July, and basically having two standards. So the first standard will be the IFRS S1 standard, which deals with general requirements for disclosure for sustainability related information. And then the S2 standard focuses on climate-related disclosures. All right, so the S2, the climate one, is basically prioritized because they say that that's one of the hot topics out there. They're also working on other topics like biodiversity, air pollution. That's also, upcoming topics that will be published as we go along. But climate was basically prioritized at this point in time. Right, so with any other, IFRS standard, you look at the qualitative characteristics of financial reporting. And in this case, they also, apply the same principle, looking at the conceptual framework with the same principles, basically, of saying, we need information that's relevant and faithfully represented as the fundamental principles. And then obviously, there are some enhancing principles as well, such as comparability, understandability, timeliness, and also verifiability. All right, so all of that builds into the standard setting process that they want to ensure that there is still relevant and faithfully represented information that will enhance the usefulness of the information in the financial statements. Right. So if we move over to the objective, right? So what did they actually want to achieve here? Okay, so the objective of the IFRS S1 standard is basically to require entities to disclose information about significant sustainability-related risks and opportunities. Okay, so it's just significant sustainability-related risks and opportunities that is basically useful to the primary users of general-purpose financial statements. Okay, so if you look at that first part, there's basically you've got users of financial, general-purpose financial reporting statements, and they want useful information. All right, and not only now about the financial stuff, they also need sustainability-related risk and opportunities, okay, to see that as well. And why do they need it? All right, so when they look at a particular company, they sometimes want to assess the enterprise value, and we'll talk about that a bit later. So what is the enterprise value? But also, when they decide whether or not to provide resources to the entity. So if you provide funding to an entity, are you funding an entity that is responsible from an ESG point of view? Are they sustainable? Are they looking at, the impact on the environment? Are they good in governance? All those elements that they need to look at. You need to provide that useful information to these users of the general purpose financial statements. Okay, or financial reports. Then, if you look at the scope, so which companies should apply this? So this is quite broad now. So they say basically an entity shall apply this standard, preparing and disclosing sustainability-related financial information with the sustainability disclosure standards. All right. So this exposure draft that we're talking about, that is in line with the IFRS sustainability disclosure standards. Okay. Then basically they're saying is that if you may apply the disclosures, right, when the entities related financial statements are prepared in accordance with IFRS or any other GAAP. So basically opening it up not only to IFRS, but also if you're a US GAAP reporter, that you can also apply the standards here. Okay. So, and again, this is, they say they may, because I think, again, it depends on our legislation also, is that, what does the Companies Act say? Does the Companies Act now say that you need to publish this together with your financial statements? And I don't think we're there yet. For the JSE, it might be different going forward. They might include it as a listing requirement. But, I can't really comment on that. I don't know what will happen in the near future on that. Okay. And something very interesting also on the IFRS S1 standard is that they focus a lot on value chain. And that's something that possibly comes from integrated reporting, where you talk about the business model, but the value chain is basically, how do you create value and what elements there actually influences your value that you create. All right, and the standard actually wants, again, information about sustainability risk and opportunities across the company's value chain. Okay, and then what is the value chain as defined in the S1 standard? So it's the full range of activities, resources, and relationships related to a company's business model and the external environment in which it operates. So it's basically, activities, resources, relationships, in a business model. So you need to almost have like a timeline of, when do you start, where do you end, what's in this process, and how does it relate with the external environment, the communities, the customers, what do you call it, the government, what role do they play as part of the external environment? So if you look at the value chain, so this is just an example. So let's take a normal company that manufactures something, maybe manufactures pharmaceutical drugs, for instance. Okay. But anyway, so the purchase of the raw materials, for instance, you can ask yourself, what is the risks and what are the opportunities relating to that? The manufacturing, the storage, the selling and distribution, the consumption by the consumer or the customer, and lastly, what happens with the packaging at the end. You need to understand the sustainability risks and opportunities relating to this whole process. And obviously, this is very specific to your entity, your own business model. You can't just take this and say this is going to how it's going to be. Every business model looks different. But again, if you look at risks, for instance, if you look at the purchase of raw materials, you can have a sustainability issue in terms of high carbon suppliers. You might have suppliers that has high carbon as part of their emissions, or as part of their product that they provide to you. And then also they can have some other unethical practices that could actually be a reputational issue for you as an entity. All right. So that's one of the risks as part of raw materials or that you purchase. The manufacturing, are you using water resources? Water is a scarce resource, and wasting water can be a risk from a sustainability point of view. GHG emissions, greenhouse gas emissions. If you're burning coal or diesel to operations like we do now currently with load shedding. So it's a tough one. But that's a risk in terms of sustainability. You could have poor HR practices where you pay people less than minimum wage and make them work excessive hours. That's not conducive in line with the Employment Act or of South Africa. Or the regulations in place. So that's another. It's not only climate related. It can also be HR practice. It can be an ethical way of dealing with the communities, bribery, etc. From a storage point of view, again, if you store a certain product, what happens? Again, is it clean storage, or you also, have greenhouse gas emissions, CO2 emissions that you have in terms of storage? Is it chemical storage? Is it safe? Are you in line with the legislations out there? And then if you look at the selling, so you're selling your product, again, your distributors, this GHG emissions on that. You could have a situation where you might start losing customers because of high carbon, for instance, or the HR practice not being in line, or dealing with companies that are unethical. So that it's that's where the stakeholder activism comes in. Sometimes you will sit in a situation where you've done something that impacts your customers, and that customer will actually just move away. Sometimes they move back, like the Dis-Chem case, for instance, where they had certain practices, people boycotted them for a week, and then they were back there. So sometimes it's temporarily, but sometimes it can be permanent. So it depends on the type of issue that you have. Then also the consumer the consumption. So again, are there any risk from a customer point of view? That you might have taken some shortcuts as part of the manufacturing, and then the defects can influence the customer at the end of the day and have a detrimental effect on your reputation and your relationships with the customers and society. And then also plastic, if you look at the packaging, so if you've got, if you think about Woolworths or any other retailer, the plastic packaging, the single-use plastics, the impact that has in terms of landfills, waste management, ocean pollution, what are you doing about that? Again, how can you change it, and what opportunities also sits with that, right? And that's where my next point comes in. So with risks, there comes opportunities as well. If you look at a SWOT analysis, opportunities, threats, weaknesses, strengths. So you can think about that. So with the risk, you also have opportunity to get greener supplies, but with that, it also comes with another risk of paying more, making less money. If you look at manufacturing, recycle the water, you have invest in renewable energy. Selling and distribution, you can again have greener products that you are selling and distributing. It can be ethically sourced, raw materials. It could be using distributors that are greener as well, or alternatives that has less of an impact on the environment, maybe be more efficient. If you think about drones, I heard In Australia, they have drones delivering, food parcels and, groceries to their customers, where we still, having the Checker 6060 and all those nice things. They are on the drones phase already. And then again, if you look at consumption by the consumer or the customer, so is there opportunity there to develop another product that's better, more efficient, greener? And again, think about, ensuring that, you've got something that is ethically sourced, that's clean, and hopefully still making money out of it as well. Otherwise, it could be a situation where, it could be detrimental to your business. Then the final one, destroying packaging. So maybe, think about alternative ways of packaging it, having your own recycling process with customers, maybe, to say like, for your next purchase, you might get, a discount if you bring us X amount of plastic, and you have your own, recycling of certain things that's happening in-house as part of your business, So again, this is very hypothetical, not always practical, but it's something to think about as part of your business. And this is not, not a complete list. So there are other things that you can also consider. So I'm not sure if there's any comments on this that anybody wants to make in terms of the value chain, and how you need to think about sustainability as part of your value chain. Any comments, questions on this? See, it's quite quiet there in the Q&A. It's still, well, if there's something popping up, I'll stop and I'll answer it or talk to it. But please, if you have any comments or anything that you want to talk about, just let me know. Cool. All right, so in terms of the value chain, what should you disclose? So firstly, it needs to be specific to the company. So like I said earlier, you can't have a generic situation where you just, disclose stuff for the sake of disclosing it. It needs to be something that's related to the company. And again, it needs to be information that will enable investors to assess the enterprise value. So and that's again where the materiality things comes in. So it needs to be something material to enable investors to assess the enterprise value. So immaterial things will not, possibly will not influence investors. But if something will influence the enterprise value and investors are interested in that, then it's something to consider as part of disclosing. And again, with value chain, I had an example now there, but it's basically comes down to that, the relevant information will depend on various factors, various processes, resources, elements that you need to take into account. The type of employees you have, the type of sector you're in, the products that you are selling, the process that you're using in terms of manufacturing, etc. So it's very, very entity specific, and that's why it's so important for you on your own that you need to take on this journey. So what other questions that you need to ask in terms of the IFRS is 1 standard? So the first one is, what should be disclosed? So again, it's all about material information. So again, like I said just now, is that it won't help just showing all the information relating to sustainability. If it's not that material and won't influence, then you shouldn't be disclosing it. And again, applying, using the judgment as part of, sustainability related information, when will that actually have an impact on the enterprise value? And if that has an impact, then you would most likely deem it to be material. So, and again, talking about enterprise value, what is enterprise value? So this is basically a finance type of definition of it, but the ISB also provide this definition, or the ISSB, sorry. So they say it's the total value of an entity's equity and net debt, and reflects expectations of the amount, timing, and uncertainty of future cash flows over the short, medium, and long term, and the value attributed to those cash flows. All right. So basically reflecting the cost of the capital. All right. And again, that short, medium, and long term is something that I think derives from integrated reporting, because there they talk about value creation over short, medium, and long term. So it's something that they brought in from integrated reporting there. So, and again, what information is then relevant for enterprise value? So again, it's not only financial statements information, because we have spoken about, that, climate change, for instance, can impact your financial statements. So it's actually broader than that you need to consider. So you need to include information about the impacts and dependencies on the people that you have in your value chain, how you influence the planet and the economy when you are assessing the enterprise value. Okay, so the people, planet, economy terminology actually comes, from the early 2000s, but it's something that's still relevant. It's a simple way of looking at it. It's not only the company, but also the people involved in value chain, the planet, and the economy. So where and when should I disclose? Okay, so important that the disclosure should form part of your general purpose financial reporting, and that's why they also require you, or they want to basically say that the disclosures for sustainability need to happen at the same time as the financial statements, which could be a massive administrative burden, or it could be onerous for the reporting people at the firms or at the companies. But again, this could change going forward if you look at, when the actual issued standards come out. But this is what has been proposed in the exposure drafts. All right. So if you look at the IFRS 1 standard, there are 4 core areas that you need to focus on in terms of disclosure. Okay, and those 4 are governance, strategy, risk management, and metrics and targets. Okay, so basically, if you look at that image there, the governance basically overarching, influencing your strategy, risk management, and metrics and targets. And the strategy is basically your plan on how you want to achieve certain goals and how these sustainability, risk, and opportunities play a role in that plan. The risk management, again, how do you identify and assess the risks? And then lastly, the metrics and targets. So how do you set targets, but also how do you monitor that on an ongoing basis? Okay. And like I mentioned earlier, so the ISSB used the TCFD approach as guidelines for the standards. All right, so if you look at those 4 areas again, just on the governance, so what does the governance, from a governance perspective, what do you need to see? So you want to understand the governance processes, the controls that put in place, procedures that are used and monitored, are used to monitor and manage sustainability related risk and opportunities. So it's basically governance that we all know, but focused then towards sustainability. So by basically broadening your view of not only financial statements, but looking at how you're managing the risk from a sustainability point of view as well. Then from a risk management, so what is that? So you want users to understand the process by which a company identifies, assess, manage the risks that they have currently, but also prospective risks that they might have for sustainability related risks and opportunities. And also, how does these sustainability risks and opportunities integrate with the business model and the overall risks of the company? Okay. Then from a strategy point of view, again, you take the risk and you address those risks, but also how do you plan that? How do you allocate resources to ensure that you're sustainable in the future? All right, and how are you actually going to make money? How are you going to influence how are you going to generate cash flows for your enterprise value? And how does these risks play a part in that? And then lastly, the metrics and the targets. So basically, to enable investors to understand how you have monitored, what metrics you've used, how you determined it, to make them understand how, the information that has been provided to them. Okay, so let's first look at governance. So like I mentioned earlier, is that the governance is basically the governance that as in King 4 or the Companies Act, but now it has a focus on sustainability, risk and opportunities. Okay, so you need to have a body responsible for oversight. You need to have terms of reference for that body. You need to make sure that these people on this board actually has skills and competencies to oversee these strategies. And basically also to say like how often the body are informed about sustainability, risk and opportunities. So to have meetings and to make decisions on meetings, to be able to address certain sustainability risks and opportunities. So it could be your board of directors. It could also be a subcommittee that they have established for sustainability, for instance. Okay. So then if you look at the other disclosures that is needed, so again, focusing on how. So they want to see how the body and its committees consider sustainability-related risk and opportunities when overseeing the entity strategy. All right, the decisions that they are making, the risk management, how they would monitor it, how sensitive they are towards, these risks and opportunities. Also asking, how the body oversees setting targets. So a very important thing there is that in recent years, if you look at remuneration of directors on a JSE, especially for the mining industry, you would see that more and more companies are bringing in ESG KPIs or parameters as part of their remuneration policy and targets that they need to meet in order to get remunerated. So especially the long-term remuneration that you would see. So important there. So by having these metrics and targets and strategies, you need to link that strategy with remuneration also. So there's also a drive towards that. So that's also important. And again, how does management assess and manage these sustainability risk and opportunities? Basically saying like, who's at the end of the day, who's responsible? Are they just overseeing it? Who's actually doing the groundwork? Who's doing the work, putting the information together, making the decisions, etc. All right, and what type of disclosures, or not disclosures, what type of controls and procedures that they put in place to ensure that they address these risks and opportunities. Okay, so it's basically governance with a sustainability focus. Right. Then if we move over to strategy, so like I said now earlier, so the governance will have an oversight of the strategy or the strategic outlook of a company or from a sustainability point of view. But again, what needs to be disclosed from a sustainability, from a strategic point of view now. So basically, the significant risks needs to be disclosed as well as opportunities that could affect the business model, basically the value chain, the business model, the strategy of the company, and the cash flows, and how it would influence access to finance also. So, basically, will certain things in terms of the climate change, for instance, influence your ability to fund more aspects of your business? Or will banks, for instance, there's a strong drive in banks for funding cleaner energy now, by being high on CO2s, will you get further funding from banks going forward? Because that's one of their strategic drives, obviously. So that's one thing. So also the effects that these risks and opportunities have on the business model and value chain, and they give information on that. So again, you need to understand what aspects of the business model gets impacted, and what will they do to mitigate it. So also to say, like, what resources do we need to put into place to be able to ensure that, the business model and the value chain remains sustainable. All right. Then, in terms of the effects, so also you need to show the effects on the strategic and decision making, and they give more detail on paragraph 21. But again, it's about, assessing these risks and opportunities and say, like, okay, what decisions are we going to make in order to be strategically aligned with what we want to do and achieve, and considering the sustainability aspects as well. Then also the effects of the sustainability risk and opportunities on the financial statements. So basically statement of financial position, performance and cash flows. And this is something that's quite new actually, because in the past it was all about, just showing, what the effects or what your strategic outlook is, what are you doing in terms of climate change, but you're never showing what the impact is on your financial statements. And that's something that's quite insightful and new in this standard, is that it brings in the impact on the financial statements, the cash flows, the projected cash flows, and basically impacting your enterprise value at the end of the day. All right. And also to say, like, how does it look from the short, medium, and long term, and how will it influence your planning going forward? If climate change is so significant, and if you're a motor vehicle manufacturer, and you've got cars that run on diesel and petrol, and the whole world is moving towards hybrids and electric cars, how are you going to adapt in terms of your planning from a strategic point of view? Are you going to enter that market, or are you going to basically see it out and see what happens? Is there a market? Are you going to grow? All of those questions that you need to ask. Okay. Then also the resilience of the strategy. So again, looking forward, and saying that the information based on your business model, do we need to change it based on our risks that we have from a sustainability point of view, and what do we need to change? All right. Then risk management. So basically, to identify it, to manage it, and again, looking at, you identify it and then saying, okay, is this significant? Is this a lesser of an issue? I see there's a question coming through. Yeah, so that's a good question. There's a question on a financial statement. So the person asked here, will the impact on the financial statements be indicated in the statement of financial position, statement of comprehensive income or cash flows, or as specific line items, or in the notes? So I think it will most likely be in the notes. All right, and that's where connectivity comes in. So I'll talk about it a bit later. And the thing is, currently very limited guidance on what they actually mean by all of this. So my view is that, you would most likely see it in the notes, where they integrate the accounting and sustainability as part of the notes. So if you're looking at, for instance, ECLs, and climate change has impacted ECL significantly, providing more bad debts that you used to, then you would say, as part of your forward-looking information, you looked at the impact of climate change on your customer base, and therefore, that you will basically increase the ECLs for this reason, and based on that sensitivity as well. Okay. Then from a risk management point of view, you need to assess the likelihood and the impact of the risks. All right, looking at qualitative factors and quantitative factors. You need to explain what parameters you are using to determine, what is significant, what is not, what assumptions you've made. And if there are changes in prior periods, you need to notify, or you need to explain what those changes are. All right, so it's what companies normally would disclose in integrated reports, maybe a little bit more here and there, but it's pretty much what is already in integrated reporting. So I just want to show you more or less. So if you are assessing the significance of certain risks, you look at, the likelihood and the probability, probability and the impact of these risks. So basically having this matrix, or a risk matrix, that you'll probably discuss. And this is something that you see in integrated reports quite often. And this is, again, I think this is Clix's version of this. So they've got their top, 8 risks that they are showing on this matrix. and basically showing, you know, what happens before mitigation, so inherent risk versus after they are mitigating it. So just showing that if they're doing something about it, it reduces the probability and the impact of these risks, most likely, you know, from something that is quite catastrophic and has high certainty, moving it down to that it could happen, but it's still a major risk, but they are dealing with it. All right. So obviously I don't have the information of these risks, but you can have a look at their integrated report and just, you know, understand, you know, what these risks are. They're basically mapping it out in terms of the impact and probability of certain events happening, you know. And again, it needs to integrate with your overall risk assessment as well. So it's not only sustainability related aspects. So maybe some sustainability aspects won't even make it to the top 10 risks, but you need to go and assess them. But what you would basically disclose at the end of the day, you would disclose it together with your, you know, overall risks of the company. All right. You might have a lot of suppliers. You might have the COVID-19 pandemic, you know, if it was 2020 or 2021. It might be climate change. You know, that's something that comes up there quite often. Might be political unrest. So all of those aspects that you need to consider from a sustainability point of view, but also from an overall point of view as your risk management in the company. All right. And again, the process to identify and prioritize sustainability related opportunities as well. And again, the process to monitor and manage these risks and opportunities. Also to show the extent to which how sustainability related information or identification, assessment and management process is integrated to the overall risks of the company and the risk management, and how it's integrated into the management process also of the company. So the last two bullet points are basically what I've mentioned here in the previous slide, where, you know, you're looking not only at sustainability, but also sustainability in the context of the business as a whole. So it's not to isolate sustainability. Right. Right, and then the last one is to look at metrics and targets. I'm just checking there. Yeah. So after this, we'll just take a break, like a 5 or 10 minute break, and then we'll deal with the last standard after that. Just going to check here quickly. 1, 2. Yeah, basically 5 slides. So I think I should be done with the next 10 minutes on that, and then I can give like a 10-minute break just to, you know, grab a coffee, take a breath of fresh air, and move on. Okay. So metrics and targets. So this is probably one of the important aspects of the standard. So I think what happened in previous frameworks is that everybody's got their own metrics, and, you know, yes, you know, a bit more guidance in terms of, you know, metrics, how to use it, how you define it, what inputs you are using, in order to get more useful information. Because if you look at the integrated report, for instance, sometimes I just have a lot of metrics there. You don't know how they got there. You don't know how it's measured, and it all looks amazing, but it's not really useful. Okay. And it's all about, again, providing useful information to assess how you've responded to these risks and opportunities. Okay. So if you look at the metrics, they say it needs to be metrics used to manage and monitor sustainability risk and disclosures. And it's basically it's a performance measure, it's a KPI. So you want to see progress towards a certain target and what your progress is compared to previous years. So you need to be able to compare year 1 with year 2, for instance. All right, or over 5 years, depending on how you want to do it. So when you develop a specific metric within the entity, so you're not using a metric that's out there already, so you're developing your own one, then you need to go and explain how you got to it. So how did you define it? What is your measurement? You know, what is the numerator versus the denominator in the metric? You know, is this validated by external body? You know, because if it's something internally developed, but you haven't validated it at all, it takes away a bit of the usefulness of that information. If it's something that, you know, hasn't been confirmed, hasn't been assured by someone else. Then the explanations. So if you have, developed it, you need to explain, the methods used, the assumption that you are using as part of the metric, etc. Okay, so this is quite important. So because this is now if you have developed your own metrics. All right, then there's also metrics that they've used, that's out there, that's industry or framework related metrics, so such as the SASB standard. So they do say that if you are using if you want to use SASB related information, you can use it. All right, and then you can say it's used by the SASB, and this is the metric, this is the specific industry that it's covering, and this is what you want to achieve, etc. Okay. So again, if you have information, so you need to show information about the target and the progress towards the target. So by showing, what metric are you using, the period that you are in which the metric applies, what is the baseline period or the starting period, are there any milestones that you are achieving in between, or are there any interim targets? And you need to explain that information, especially if it's a long-term type of goal. For instance, climate change, if you want to be carbon neutral, it's a long-term goal, and there are certain things that you want to achieve by 2030 or 2035 or 2040. So you need to show it over that period then. And an entity shall also disclose the performance against disclosed target, the analysis of the trends, was it good or bad, what happened, what is the reason for it moving up or down, are there any revisions, and if there are any revisions of the targets, why did it happen, and how, you need to explain, those revisions that you've made. And if a target is changed or replaced, you need to also again explain the changes, the reason why the new metric is more useful, provides better information, etc. And then you also need to provide restated comparative figures to ensure comparability between the different metrics. All right. And it needs to be precise names for the metrics. You can't just use random names and generic names. It needs to be clear enough for people to understand. Right. So if we move over to the general features, so this is where, if you look at the IFRS 1 standard, you actually get a lot of flavor from IS 1 here. So there they talk about the general features, fair presentation. And if you look at the blue box there, you see they talk about comparative information, frequency of reporting, location of the information, use of financial data and assumptions, source of estimation uncertainty areas, and statement of compliance. So a lot of those things are stuff that comes from the IS 1 standard. So that you need to have comparative information. It's important. The frequency of reporting is pretty much the same as IS 1. The frequency of reporting actually has something very important where they say that the sustainability related information needs to be published at the same time as the financial statements. So, that's something that's quite unique. And then again, who is the reporting entity? Who needs to provide this information? So again, it aligns with IFRS. So if you're a group company, you need to provide it then for the group as well. So the same as the financial statements. Again, use of financial data and assumptions. So, how do you use it? You need to explain it. If there are sources of estimation uncertainty, you need to disclose those sensitivities, what the judgments are that you've used. If you had any errors, you need to go back and restate it like you would do with IS 1. And then also statement of compliance, that you say that you have, performed disclosures in line with the IFRS, the ISSB disclosure standards, and that you are complying, etc. Okay, so that's just general features there. But again, talk about fair presentation quickly, to ensure that the information that you've provided is faithfully represented, of the risk and opportunities, and that you're looking at relevant information that's also complete, accurate, and neutral at the end of the day, and not biased information. Right. Then I also just want to talk about connected information. This is something that's also quite unique, and I think it comes also from the concept of integrated thinking, integrated reporting. So the IFRS is one standard, also talks about connected information, that information needs to connect with each other. So what information needs to be provided? So you need to provide information to the users to assess how information about the risk and opportunities is linked with information in the general purpose financial statement. So basically describing the relationships and the links between different pieces of information. So what I've, that's just an image that I've created for everybody just to see. So you need to link everything with everything, basically. So how, if you look at environment, so if the environment gets improved, what impact does it have on the financial statements? Are there certain costs that you've incurred to ensure that you go off the grid, or you have cleaner energy, lower greenhouse gas emissions, etc.? How does the relationship with the stakeholders affect your strategy, your impact on your financial statements, your profitability, etc.? So it's a very, it's something, again, very specific that you need to apply to your entity, and how the sustainability related issues impact your financial statements. Okay, so it's linking the non-financial or sustainability information with the financial information, and that speaks to that other comment asked, where would you see the sustainability impact on your financial statements? And it will be integrated, basically. So it won't have there will be a separate disclosure most likely, but you need to integrate into the financial statements in the disclosures, referring back to the risk somewhere else, and what that impact of the risk is on the specific area of your financial statements. Okay, so just a couple of examples of connectivity. So here's a company that has a production facility that generates high levels of GHG emissions. The company decides to close the facility. Okay, so what does that decision actually imply, or what's the implications for that? So firstly, what type of information do you disclose? You need to disclose the financial consequences of that decision. Okay, so that facility will probably have a reduced useful life. There might be impairment there. So that's from a financial statements point of view. There might be some restructuring obligations there, where certain staff gets retrenched. But with the financial, there's also the environmental aspects also. So now, to improve the environmental aspect, you need to make this trade-off, okay, to make that link as well. So what they've showed there with the disclosures, basically the financial disclosures linking with this environmental issue of closing the plant or the facility because of high GHGs. Okay, another option could also obviously be is that you take that facility and you transform it into a green facility, renewable energy, solar panels, wind distribution, or whatever. That's an alternative to basically closing down, and people losing jobs and the community suffering from it, etc. Okay, so that's the first example, but that just shows you, what you need to think about in terms of connected information. The second one is a company supplier has recently been found to have employment practices that fall short of international norms. The company decided to terminate its contract with that supplier. So now, if you look at the value chain, you're at the start, it provides you your raw materials, most likely. What will the impact be? Okay. So firstly, you need to cut ties with that, and you need to explain then, what implication will that have for your product, most likely. Okay. So could it have a cost of the supplies, of your raw materials, which would actually increase your costing of your product that you're selling. And now suddenly you might have a situation that you're less profitable. Okay. But by disclosing this, maybe your customers understand that, and they would still consider buying this product at its normal price, or still investing in this company because of making this decision, being more ethical and clear and transparent in terms of what they are deciding. All right, but it's very complicated. So I'm not sure, if you have any comments, any questions on this. Okay. All right, doesn't seem like it. Maybe people are just typing it out. Maybe if someone wants to ask a question live, you can also do that. If not, then I'm going to give us, Danny, if you're happy with that, maybe just 10 minutes break just for everyone just to take a breather.
Yeah, we restart again at 1:45.
Happy. Perfect. Thanks, everybody. Okay, I hope everybody's back. I think we're ready to go. Okay. Right, so let's talk about the next standard, which is the climate change standard. And again, very similar to the previous one, but people also wanted all the global problem area is the fact that there's also a climate related issue, and they need to prioritize that as part of sustainability standards. Okay, so and the people want to understand how climate related matters and risk and opportunities actually affects the statement of financial position, like I mentioned earlier, the cash flows, the enterprise value, the strategy, as well as the business model. Okay, but what we've done already is actually a good baseline in terms of what to expect, right, in terms of the disclosures. So the approach is very similar to the previous standard I've spoken about. And again, it's also based on the TCFD recommendations, but now it's got a climate-related focus. Okay, so let's firstly talk about the objective. So the objective basically, is to provide information for investors to understand the effect of climate-related risk and opportunities on the enterprise value. So very similar to the previous one. And so where they spoke about sustainability, now it's focusing in on climate-related risks. And again, using those 4 core areas or focus areas, still relevant in this standard as well. Now the scope is a bit different. So the scope now focuses that you apply climate-related risks. So the standard will apply in cases where climate-related risk is evident in a particular company. So when a company is exposed to climate-related risks, this standard will then be applicable to them. Okay. So there are 2 types of risks. So you've got the physical risks from climate change, which is basically severe weather. It can be your, the rising ocean levels, rising temperatures, droughts, flooding, etc. Okay, but then there's also transitional risks with relation to climate. So basically moving away from high carbon business models to more greener greener companies and lower carbon business models. People talk about zero carbon, etc. Okay. Then also, with the risk, also again, you need to talk about the opportunities that will be available to the entity that has been exposed to these risks. So if you look then at the disclosures needed, all right, so again, I say that they're using the same principle as the S1. So again, focusing on governance. So, what processes are in place, controls, procedures to ensure that the risks and opportunities are monitored, in an efficient way. Then from a strategy point of view, again, to see how the climate-related risk affects your risks, but also the business model and how you basically create value and how you plan the future in terms of your strategy to be effective in being sustainable and creating value over the short, medium, and long term. Then also risk management. So again, the process to identify, assess, and manage the risks, and the metrics and targets. So basically the information, and this is where the information gets very interesting, because now you're focusing your disclosures on carbon, and you're looking at CO2 emissions, GHG emissions. You need to use the GHG protocol, the level 1, 2, 3 emissions, so it gets very technical. And it's almost like you need to have a separate, then you almost need to have like a separate seminar just on this particular standard and how to measure the GHGs and, you know, how to calculate it and how to report it. So it's very technical. But anyway, so if you move over to that, so if you look at governance, so it's pretty much the same as the previous one with a focus on climate. So again, process, it's just a disclosure on the process, the controls, the procedures to manage the risk. And again, you need to have a governance body. It can be the board, it can be a subcommittee. You're looking at the terms of references, the mandates, the skills and competence. And then specifically, again, looking at how they will actually oversee risk management and strategies and how they will monitor that. And again, that's where you probably see remuneration practices as will change, you know, that they link performance bonuses not only to financial performance, but with climate related targets, etc. And that's what we're seeing in the mining industry. Then also, how does this integrate with your strategy and risk management as well? So it's not only from a governance point of view, but also saying, you know, how does it play a part in your value chain? How does it play a part in your business model and the forward-looking information, etc. Okay. So from a strategy point of view, again, very much similar to the previous one. So you need to look at your business model, you need to understand how climate change or climate-related matters will influence your value chain at the end of the day. And then if you go back to the previous slides that I have, you know, with that value chain, think back, you know, when you're purchasing your raw materials, when you're manufacturing, when you are storing it, when you're selling it, when you're looking at the packaging, you know, where will climate actually have an impact on that? And where should I possibly make changes, you know, from a climate point of view? Then also, you know, from a decision making, how do you make sure that you transition? For instance, if you look at the risk, the physical risk and the transition risk, you know, physical risk, how do you mitigate, you know, the impact of climate change in your company? But also, you know, if you need to move, you need to change your business model to a more cleaner product, a more cleaner service that you're delivering. How are you going to do it? How are you going to manage that transition from carbon to carbon neutral or lower carbon? And I need to explain the decisions that you are taking and the outlook on that. And also, again, the impact on the financial performance, the financial position, the cash flows, and what trade-offs you need to also make, you know, from that point of view. If you want to be greener, you need to make some sacrifices from a financial statement point of view. You know, you maybe spend more money in going greener, going off the grid. You know, in South Africa, you know, at least Eskom is making it easier for us to go greener. You know, just as a basic point of survival. A lot of people are going greener. A lot of companies are investing in renewable energy to go off the grid and not be reliable, and not to rely too much on the Eskom grid. But there should be other reasons also, most likely, for moving away. And also, if you look at climate resilience again, so, you know, the outlook of climate, you know, how resilient is your business model in the short, medium, long term, looking at climate related risks. You know, if you, again, like the example I've used at the start, if you are a company manufacturing diesel vehicles, and the move out there is to go, you know, greener, hybrid or electric vehicles, you know, how are you going to change your business model? How resilient is your business model with that? Do you need to transition? Do you need to make some changes here and there? All right. So you don't want to be in a situation where like Kodak, where, you know, the move has been so quick and so effective that, you know, you basically priced or out of the market very soon, you know, if you don't adapt quickly. But yeah, it's just to have that strategic outlook from a climate point of view as well. Okay, so I've mentioned earlier that you need to talk about two types of risks, which is your physical risks. And then they basically have two types of physical risks. You've got your acute risk, which is your extreme weather patterns, you know, your flooding, your extreme droughts, cyclones, tornadoes. We've got lots of tornadoes in the last couple of years here in Gauteng, which is quite weird. Then, the chronic stuff is the rising sea levels, rising temperatures, which also changes your climate. So those are the physical risks, but then, as I mentioned, the transitional risks. So, transition from high carbon to low carbon, possible political elements that you need to take into account, legal considerations, reputational considerations that you need to make. Maybe there are some legislation that is changing. For instance, I think a lot of South African exporters are very nervous currently of what's happening in the EU. A lot of green mandating happening, sanctions that could be posed against you if you don't don't meet certain requirements, because again, we are also part of their value chain. So if you're not green enough, according to their mandate, then they would just refuse to allow you to export, or they will just need to send you stuff back. So it becomes a very globalized issue, obviously, and it's something that you can't hide away from. I think is the fact that you need to go and lower your carbon footprint. You need to weigh yourself in terms of, are you weighing too heavy on that? What is out there, and what are the risks for me as a business? Because if you want to be sustainable, you need to move with the times, with the requirements that's out there in the market. Okay. If you move on to risk management, again, very similar to the S1 standard. So they're focusing on risk, again, how it's managed, but now focusing on climate specifically. And again, it's about how does it fit in? So it's how do you assess it? How do you prioritize it? But also, how does it fit into the rest of your risk management on the overall point of view? How does it sit within the business model of the company? And how are you going to basically measure or manage that risk going forward? All right. So a couple of things on risks. Just a simple example that the ISSB has produced. So they say a company in the automobiles industry might review the requirements and determine that the disclosure topic, fuel economy and use phase emissions, is relevant to its circumstances. The disclosure topic notes that more stringent emission standards and changing consumer demands are driving the expansion of markets for electric vehicles and hybrids, as well as for conventional vehicles with high fuel efficiency. So basically, if you're a company, you need to basically move with the time there. All right, so there's a couple of things that you need to consider from a transitional risk. So the company needs to basically mitigate the risk of changing buyer preferences and adapt their business model. So basically what I said earlier, so if you are in a situation where your business model is quite high on coal, and if your market and your external environment is moving in a different direction, you need to move with that if you want to survive. Obviously, if your environment stays the same, if you're local and it's still very coal dominated in South Africa and Africa, then you have less of an issue. Okay. Then climate related opportunity also. So what the opportunity here is not only the risk, but the opportunity is then basically to say, okay, we need to innovate, we need to also come into the market with a product that actually can have a piece of that market, or have a market share in this market of electric vehicles or hybrids or high fuel efficiency. So it's typical things that you need to think about. But again, if you now think but further than just the risks and opportunities, but you can also now think about how does this connect to your strategy? How does it connect to your value chain? Where are you going to make these changes? You can have a think about the impact that it will have on your cash flows in the future. So you'll need to maybe change some technology in your own company. You need to invest in R&D, develop new procedures. There will be a certain cost involved in this. So there's definitely a connected approach that you need to take. You need to think in an integrated manner. You need to link all these different elements in order to create the value that you need at the end of the day. Okay. So then the second one is that a company that said one proposed requirement is to disclose information about how a company plans to achieve its climate-related targets. And then basically, if an automotive company has established an emissions reduction target, it could demonstrate progress towards that by disclosing metrics associated with the fuel economy and use phase emissions of the disclosure topic, which include fuel economy of the vehicle's fleet and also sales of zero emission vehicles. So depending on, what the target is. Okay, but we'll look at a bit more detail on the metrics a bit later in the session. This is a very, very, very basic example of disclosure. All right, so this is definitely not the standard of what needs to be disclosed, and I think there will be more guidance coming out from the ISSB in the next couple of months. So there will definitely be more upskilling coming in the near future. All right. So if you're looking at metrics and targets, so this is where I'm going to spend a bit more time. So this is specifically focused on climate. All right. And they say the entity shall disclose information relevant to the cross-industry metric categories, and which are all relevant to entities regardless of the industry and business model. Okay, so there's some stuff that is standard for all companies, such as GHG disclosures, the greenhouse gas emissions, but there are also industry-specific metrics that can be used. All right, and what is nice about having the SASB joining in and the CDSB being consolidated, there's very good industry-based metrics that can be used within the IFRS scope of things. And in recent, I think as part of the consultation process now, they also said that the GRI standards are also allowed to be used as part of the metrics and the risks and all of that. Okay, so yeah, so you need to go and think about, what is your industry, which industry your company fits into based on those list of industries, and choose your metrics based on those. Okay, so and then there are also other metrics used by the board. You need to basically then go and explain what those are, right, and why they are using that. And again, it's almost the same as the previous one. We need to explain a bit better in terms of what is used, why you're using it, etc. Then the targets set by the entity to mitigate or adapt to climate-related risks or maximize climate-related opportunities. You need to disclose that as well. So if you look at that first one there, the cross-industry metric categories, all right, that's basically what we're dealing with here. All right, so the greenhouse gas emissions. So anything related to CO2 emissions, greenhouse gas emissions, you need to go and disclose it. And you need to disclose a couple of things. Well, yeah, a lot of things actually. So first, you need to disclose the absolute gross greenhouse gas emissions generated during the reporting period. So that's what is the number of GHGs that you have emitted. And you use the greenhouse gas protocol corporate standards. So, that's some of those principles that I've showed you at the start. The greenhouse gas protocol is one of those that is used in the ISSB standards. And again, to ensure that there is uniformity and consistency across jurisdictions and industries. Okay. So so what you need to show is your metric tons of CO2 emissions. Okay. And it will be classified in 3 different levels: scope 1, scope 2, and scope 3. All right. I'm going to show a practical example that will explain it. All right. So scope 1, I think, is direct. Scope 2 is indirect. And the third one is upstream and downstream. So it's very complicated. But I'll show you an example of one of the mining companies, what they've done. Okay. But you also need to show your intensity, so the greenhouse gas emissions intensity. So basically, so how much CO2s are you emitting based on the number of products you are selling, or the amount of coal you are mining, or diamonds you're mining, or whatever. So there must be another output to show how intense the GHG emissions is. So basically what you want to achieve here is that you want to lower that intensity of the CO2 emissions based on your production. Okay, so you might still have high GHG emissions, but it's lower in terms of how you are producing. So you effectively you're improving your GHG emission output. So take it into, and summarize a little bit. So basically what needs to happen is that you need to disclose greenhouse gas emissions, scope 1, 2, and 3, and you need to show it in metric tons of CO2 emissions, all right, using the GHG protocol. And again, the reporting entity is still the same for the metrics. However, if you have associates and JVs in your company, you need to have separate disclosures for them. All right. So if you are the parent and the subsidiaries, you've got those are merged together or aggregated together. But then if you have associates and JVs, you also need to aggregate them together and move them separate from the parent and subsidiaries. Okay. You also need to explain what the impact is on the value chain, where these emissions are happening. And also, again, the other stuff, link it to the risk and opportunities, the strategy, etc. Okay. So that's the first set of disclosures. And the second set of disclosures is then the industry-related disclosures. So, then I'm not going to go through the detail there. You can see there's quite a lot of them. So there's 77 industry classifications across 11 sectors, which means there's quite a lot that you actually need to go through, and again, it's important for you to basically, identify what is your company doing and where do you fit in the best, and then use those industry-related disclosures. And again, that is to ensure consistent metrics, and again, I think part of the disclosure is also to say that you've used this metric because your company is closest related to this particular industry in this sector. Okay. And again, with the industry-related disclosures, make sure that you link it back to the business model, all right, that you don't only focus on, the outputs, but you need to link it back and with the business model, the value chain, the strategy, and the impact that it has. So you need to almost think back on the strategy, this part here on this slide, to look at the business model, the value chain, the decision making. So you need to make those links as well as part of this. Okay. Right. So I'm going to look at an example here. Actually, I moved quite quickly through the climate one now. So what we're going to do now, we're going to look at an example of Impala Platinum, and this is the 2021 sustainability report. So they're one of those companies that have applied the TCFD approach. So, and I'm just going to show you an example of, how they have disclosed their performance of 2021. Okay. And you can see they're actually doing quite well. Obviously, there might be some new stuff in the ISSB standards that they need to upskill on. But, it's quite nice in what they have shown, and for you to also understand their exposure to greenhouse gas emissions and what they are emitting. Okay. So if you look at, they say basically our total energy consumption, which is the direct energy, plus the indirect energy, was 19,613 kilojoules. So that's like, I need to go and Google that. So it's like a billion kilojoules of CO2. That's how I understand it. So it's up 17% from the previous year. So it makes sense because in 2020, we had all those lockdowns, lower production in 2020. And they say due to increased production and a full year of inclusion of Impala Canada, which is one of their subsidiaries. Energy use intensity, so that's important. So it has decreased by 1%, 0.857 per ton, to 0.84 per ton milled. Okay. So that's the total energy consumption. Okay, and now they're talking about the CO2 emissions. So the CO2 emissions was 4,139 kilotons. Okay, I think that's the right metric if I remember correctly. Kilotons. Yeah, so they're talking about tons. Yeah, metric tons. So kilotons is just like maybe just the larger version of that. Right. So if you look at, yeah, so there they say it's 11% increase year on year due to increasing energy requirements across the group. Okay, so now I can actually see that the energy went up by 17, but the GHG only went up by 11%. So immediately now I can actually see that there's some efficiency now from, the previous year to the current year. And now they go into scope 1 and 2. So they say our scope 1 and 2 emissions are independently assured. Our carbon emissions intensity has decreased by 4% from 0.86 tons CO2 per ton milled to 0.78 tons of CO2 per ton milled. All right, so again, they're talking about the intensity there. Okay, so again, you can see actually an improvement on that. And again, they're looking here at scope 1 and 2. So it's the direct and indirect energy that has been used. And they'll talk about level 3 just now. Or scope 3. Some 88% of the group's GHG emissions are associated with electricity consumption, notably in South Africa, with a balance of 493 kilotons, mostly associated with direct use of coal and diesel in mining process operations. Okay, such as the generating heat for drying or concentrating or generating steam, and the use of propane for heating purposes in Impala, Canada. Okay, so just explaining again what those, what those number makes up. Then the scope 3 emissions. So the scope 3 emissions are all indirect emissions, okay, which is not in scope 1 or 2, that occur in our value chain, okay? So then they explain that. So they say including both upstream and downstream emissions, they are not directly within our control and are complex to measure, okay? And that's very true. So now, you need to go and say, okay, if I look at the raw materials that they're supplying, what is the emissions of getting that raw materials into my process, into my manufacturing process. But also when I'm selling it, I'm distributing it to retailers, I'm distributing it to, the final customers, and the delivery vehicles, how much emissions is there. So they rely on external parties to provide them information, and they need to ensure there's not double counting. If you think about consolidating financial statements, maybe your subsidiary is a distributor, then you actually need to do an intergroup transaction in a certain sense, from my accounting background to make sure that you're not double counting for emissions. So they say it's complex to measure, and they say we continue to working with industry experts to help improve our accounting of scope 3 emissions, and added some more sources of emissions to this category. Okay, these were mostly related to upstream and downstream transportation of commodities, okay, which makes sense. We have also included scope 3 emissions from Impala, Canada. We therefore estimate that our scope 3 emissions in the listed category at approximately 365 tons, which is based on 2020 data, and which means it's pretty much consistent there. Okay, so it's almost like a disclaimer, they couldn't get that information ready. Okay, so let's have a look at the information. So here they show the scope 1, they show scope 2, they show scope 3, and there you can see, the total emissions per category. Okay, and there you can see 2021. Okay, so you can see there's an increase, all right, but there's actually a decrease or a lower intensity going forward, and I'll show you just now. Okay, and there again they explain scope 1 emissions are direct emissions from owned and controlled sources as a result of fossil fuels. So that's their own, on their premises, if they're refining metals, whatever, the coal that they burn to refine it. And level 2 is the indirect emissions generating from purchased energy. Okay. And the third one, obviously, is the upstream and downstream of the activities as part of the value chain. So that's, yeah, I've explained that earlier. Okay. Then also the energy consumption. So here's the energy that they've consumed. Okay. You can also see, you know, it went up again from 2020. You know, the energy per refined production is pretty much the same. And, you know, the total CO2 over the refined production actually went down in 2021. Okay. So now if you move on, so the IFRS is 2, so if you look at the further disclosures on the same page, actually, if you look at, you know, if you had the document with you, they then went further just to show the energy consumption and a GHG contribution. All right, so where, you know, the blue and the green ones is direct energy and indirect energy, and the direct CO2s and the indirect CO2s, okay, for each year. And then what very important, they show the total energy per ton milled and the total CO2 per ton milled. So especially if you look at the GHGs now, so it in 2017 was quite high, it dropped in 2018, it went up in 2019 again, and then it reduced effectively over 2020 and 2021. And I think now it's at the lowest it was in the last 5 years. Okay, so you can see the intensity has actually improved quite a lot, where less GHGs are emitted in order to mine or, you know, produce your product. Okay, and this is basically, yeah, this is basically it. So I actually I thought I would be busy for the full 3 hours, but I think everybody has won a little bit of time here. So yeah, I'm not sure if there are any questions. You know, I think this is quite. I also expected some some questions along the way and some debates and stuff. So I'm not sure if they, you know, we have some time. If anybody wants to ask any questions, anything that you want to add, any comments, yeah, not sure.
There's some questions coming in the questions and answers.
Okay, great stuff. Okay. Yeah, so do we need to have verified data independently for this disclosure? Yeah, so obviously you will do your own calculation. So if you're talking about the GHG, there's certain ways to calculate it. So I haven't gone into detail on that in this section or this session, but you know, if you calculate on your own, there's ways to calculate, templates to calculate it, but you will need to get it audited or assured in some form of way. You know, just provide you a bit more, you know, stature in terms of the data that has been provided. You know, so if it's based on a GHG protocol, and you've done calculations, someone needs to just test it, and that's why a company like Implats, they actually have done it in that way. They've said, you know, they've calculated and it's been verified or assured independently. Okay, so I hope that answers your questions. So it should be, there should be some form of verification happening. I think that you've got some you know, industry experts, you know, that they're engaging with. You get your firms that's getting into the space of providing assurance on this. So yeah. Yeah, so we'll verify the data. So it's actually, I think it's the same question, maybe just a follow up on that. So yeah, so I think it would probably be, you know, environmental specialists, carbon specialists, you know, climate change specialists. So a lot of the firms are actually employing people now in that space. So so in the future you might get some services from the Big Four. I'm not sure the smaller companies are looking at it, but there's definitely space there where they're moving towards. Okay. Okay, then anonymous attendee asks, how likely is it that the standards is to be used in finance, housing market, or service industries, or is it mostly for retail? These standards are used across all industries. The finance and housing, there's also, banking is also part of it, insurance, and there's certain industries that they have, they've got 77 industries. So most likely that, housing and service industries will also be there. It's definitely still relevant. I think the only funny thing now is that, we don't know, the standards will come out, but within the next 6 months, there will probably be some decisions made in terms of, who's required to adhere to this from a Companies Act point of view. Does it mean if you have financial statements, you already need to do this? Or, are there certain entities excluded like SMEs? So I'm not sure. And again, this needs to be regulated also in a certain sense, otherwise, there's not a lot of value in doing this, so the banks needs to, the thing is the banks will probably ask for this information, eventually they will say, okay, but listen, we want your GHG emissions, we only fund you a company with an efficiency lower than X, and then you need to be able to provide that information in a report or a certificate or something. So it becomes important. Okay. And then, there's another question here. What are the auditor's duty or requirements in respect of audit and review, remembering that the auditor is not an expert in the problem? So yes, so that's a very good point. So people need to get trained on this. So in Europe, they're already starting training people on sustainability assurance. It's something that's a very interesting topic because, where does it sit? Is it normal part of normal assurance? Is it part of advisory? Where does it sit? And, is it a separate market? How does independence work? There's a lot of things that still need to be sorted out, I think. I am not in that space, so I won't be able to comment in detail. But the auditors will need to, they need to acquire people and train people on this to be able to audit it. You can't get a person that's just doing IFRS audits now suddenly auditing, the carbon disclosures. And again, you might have teams that's multi-dimensional where, which is already the case where, you've got your audit team, but they've got a technical team dealing with the IFRS, they've got a tax team. Maybe they will have a separate team then for the sustainability that reports to the audit team and, providing them information. So it broadens the scope of terms of how the teams will function, I think, from an auditing perspective. And again, I'm not sure if we will see any assurance or full assurance on these disclosures. Certain things are easily verifiable, and then others, will be quite difficult to verify. So you can't get like a normal audit opinion necessarily up there for the near future. I think it will be there will be some time before we see that. All right. Cool. Any other questions? All right. Seems like we're done.
Thank you, Milan. Yeah, I was going to say, if anyone else, if you have a question that's too long to question, just put your hand up in the tendency. I can always allow you to talk if that's easier for you. We'll give it another couple of minutes. If no one has anything to say, we'll end it off at 3:30. Let's give it a few seconds. But thank you again, Milan. It was very entertaining.
It's a new topic, and I was wondering, would I actually, I've got so much more to say, and I cut it off a little bit. So, there's actually so much more that you can
mention anything.
You can do a whole day just on climate change and carbon. There's so many, if you go into the calculations, there's a lot of stuff that you need to know. So I just keep like a a sneak peek of, you know, what needs to happen basically. So so still a lot of stuff, you know, if it gains a bit more traction, you know, in the UAE and Europe, and it's going like a steamboat, but in South Africa it's a bit slow at this stage. So, and I think we'll because we're quite reliant on coal, as everybody know, you know, with Eskom and everything that's happening, you know, so we're very coal reliant. So I'm not sure how government will align themselves with sustainability, you know. So
yeah, that gets into the political debate of whether who's got which connections, and
yeah.
It's
Anyway, all right.
anyway. All right, I don't see any questions. I think everyone is pretty happy. No one's. Wait, there's something else in the chat box. I'll say thank you.
Okay.
All right.
Thanks, Kevin.
Thanks.
All
right.
Sorry, I was listening. I didn't know we were quite at that point. A very interesting topic. I didn't understand half of it, but I'll try and mull over what you've said. My interest in this is that I think that they're going to change all these rules as go along, because other countries haven't gone on board. So, like China comes into the play, then things might even be different. I don't know. I see yesterday there's a boat off the shores of Africa where they had to return home, where they got unexplained burns, whether they got burnt from the sun or they got burnt from some other thing, then I don't know. But maybe they should also disclose what they've been doing. But thanks very much. Everybody, you'll get your certificates in the next couple of days. And Manan, always interesting. Thank you for your time and your effort and putting this together. And it was a very good afternoon to everybody, and enjoy the rest of the day.
See you next month.
But earlier, you can go home.
We're seeing you next month. We're going to do wills and estates. We're sending out the notice next week.
Yeah. Okay. Thank you.
Thank you, everybody.
Everyone.
Take care.
Cheers. Bye.